Yeah, well, I think it's reflected by what Stephen said yesterday. We're into a low growth period, we're into a low yield period. Assets are going to eventually, there's going to be a point in this cycle where returns from investing are going to plateau, and that could actually be a good result. A plateauing of returns as opposed to a sharp pullback might be a good muddle through scenario, but time will tell. But from a value perspective, we've got risk-free returns at historic lows. We all know about Australia, about 2.3% for 10-year bonds, but we've got European bonds at 0 going out to 7 years. That's extremely challenging for valuing equities. I'm not concerned about the market so much. I think the bond market is stuck, so the equity market is stuck, and the high multiples of earnings and equity seem to be sustainable because there's no alternative for investment capital. But it doesn't mean that you just have to be fully invested. I think the patience will be rewarded to get that little bit of outperformance, but you're going to have to be very patient. So the market's likely to go nowhere, but with a volatile side to it, and you just got to trade the volatility and play that game, but until further notice, I guess. We've all lost context. I mean, I guess if you're an old fund manager, you've seen 3 or 4 decades. If you're a young fund manager, you don't know what you're looking at. We're clearly looking at suboptimal growth. And the problem with suboptimal growth is the growth we're seeing in Europe is good, because it's better than negative or no growth. But the stimulation required to get that growth through fiscal and monetary policy is astronomical. And that's quite scary to think about, because we can't keep on stimulating for not much return. That stimulatory policy's got to be withdrawn or dealt with at some point in time. Now, I've got a view on how it's going to be dealt with. I think the debt side of the government ledger will be compromised. It's already been compromised in Greece, but there'll be massive compromisation in the next 10 or 20 years. The debt today will just disappear. Central banks will ensure that happens. But that's not the answer. The answer is how do we, I think we can deal with the debt, but how do we get growth? And that's really a function of fiscal policy, and it's really going to be a function of confidence in household, consumer, business sectors. And that's completely bereft in the world today. There's no confidence. And I think it's coming from governments who can't be honestly saying how they're going to deal with debt, because if they told you what they're going to do with it, then there would be either rejoicing and massive bubbles, or there'd be mass panic that debt's going to be forgiven. So it's a very, very difficult scenario we're working with. So as a value investor, you know, all I'm saying is the context is very hard to understand if you haven't been looking around, being in the market 30, 40 years. I guess experience somewhat says to me that you want to be very cautious at present. Yes, invest, but be realistic about your returns. You know, like double-digit returns, you might fluke it, but they're an aberration. You know, we're more likely to see single-digit returns, and people are going to have to get used to that.